the study material and admit card and everything, then they cannot chase the people later if the checks are bounced or dishonored. So they will not permit the payment mode which is by check, but they will permit a mode which is a demand draft. What is a demand draft? If they ask you to give a demand draft, you will have to go to the bank and you have to ask for a demand draft. For example, if you are in Madurai, so in Madurai, you will go to State Bank of India and you will ask for a demand draft payable to Madras University. Then you will have to pay 10,000 rupees or you have to transfer 10,000 to the SBI. So SBI will take the 10,000 rupees plus they will charge some commission. Let's say 50 rupees commission they will charge. So Madurai SBI will write a check. On whom? On SBI itself. So these are the checks drawn on itself. And SBI Chennai, they will issue a demand. So it will be exactly like a check, but it will be prepared by the State Bank itself. So this will be a demand draft. So those are called checks drawn on itself. You will submit this Chennai SBI payable demand draft to Madras University. They will deposit in their bank account and they will get the money. Since these are issued by the bank, they will never be returned, because after getting money from you, then only they are issuing the demand draft. This will not be dishonored. It's a 100% proof that they will get the money. So sometimes they insist on demand draft. These demand drafts are called checks drawn on itself, because drawer and drawee both are State Bank of India. There may be different branches, but one same person only. But an NBFC cannot issue checks drawn on itself. So it's one of the limitations. They cannot issue a demand draft. And then NBFC deposits are not covered under DICGC guarantee. What is a DICGC guarantee? DICGC means we have studied that Deposit Insurance and Credit Guarantee Corporation. They cover only banking companies and not NBFCs. Suppose the bank in which we have deposited money, if it becomes bankrupt, then what happens is 5 lakh per depositor is insured. How much money? 5 lakhs per depositor. It may be a public sector bank or it may be a private sector bank, but 5 lakhs per depositor is insured. Even though the bank doesn't have money, DICGC will give the money to the depositor from their funds. For this purpose, they will be collecting some premium from the bank, like an insurance company. That's why it's called deposit insurance. They receive certain premium from the banking companies. So in case of bank failure, 5 lakhs per depositor will be refunded from DICGC. Earlier it was 1 lakh, now they have made 5 lakhs. So it may be a private sector bank or public sector bank. In both the banks, we have this guarantee. Such a guarantee does not exist for the deposits we make with NBFCs. If an NBFC is in trouble, what happens? Whatever deposits we make, we will not get any money back. So any questions or doubts so far? Okay, if there are no doubts, I will proceed with the exemptions. What are the exemptions? Some of the NBFCs are exempted from registration under RBI, Reserve Bank of India. In this chapter, we are going to talk about NBFCs which are required to register under RBI. And we will not talk anything about the companies which are exempted from registration under RBI. So some of the companies are exempted from registration under RBI. The first set of companies are called housing finance companies. There are some companies who provide housing loans. They are not regulated by the Reserve Bank of India. For example, you will have Housing Development Finance HDFC, Housing Development Finance Corporation. It is different from HDFC Bank. You have two different organizations, which is HDFC as it is, Housing Development Finance Corporation. This corporation is not governed by the Reserve Bank of India, because for housing finance companies, there is a separate regulator like RBI. They will be monitoring those companies, they will be issuing circulars, they will be monitoring, and regulations will be taken care of by them. You have to get license from them, you have to renew license with them. So separate regulator called National Housing Bank, NHB. National Housing Bank is the regulator for all housing finance companies. So since there is a separate regulator, they will not come under the purview of Reserve Bank of India. An example for housing finance companies will be HDFC, or even Diwan Housing Finance also as the DHFL. A lot of advertisements you have seen. DHFL, they are also housing finance companies. They will come under the regulations of National Housing Bank, NHB. Then merchant banking companies. These merchant banking companies you will study under SEBI regulations. These are under the SEBI, so they won't come under RBI. What is SEBI? Securities and Exchange Board of India. They regulate everything regarding shares and debentures. So merchant banking companies come under SEBI regulations. Then stock exchanges. In India, there are so many stock exchanges. Most famous stock exchanges are called NSE. You might have heard National Stock Exchange and Bombay Stock Exchange, BSE. So these NSE and BSE, these stock exchanges are also dealing with shares and securities. They are finance companies, but they will come under SEBI regulation. Then venture capital funds. There are so many venture capital funds. Now there is a buzzword in the market which is called startups. Startups means they will have some novel and innovative idea, but we don't know whether they will succeed or not. This startup funding is done by the venture capitals. Startup funding. For example, we have companies like Ola. What is Ola? It's a company where we can book our taxis. This Ola is a new concept. Not now. When it came up, it was a totally different concept. They were leveraging on technology. They don't own any cars. They don't have their own drivers, but they are the largest transportation company in India. Earlier, if you want to be a travel agent, you have to buy cars, you have to hire drivers, then only you can run a travel business. But this Ola doesn't own cars, doesn't have drivers as employees, but still they operate the biggest fleet in India. So when these kind of companies come up, the banks and the normal finance companies will not be willing to give funds to them. Why? Because there's a chance of almost 95% failure. If 100 startups are coming up, 95 will fail. Only 5 will survive. Even this Ola, from the day when they have started the company till date, they have not made any profits. Year after year, only losses they are making. They are saying we are gaining the market share. That's why we are losing. Likewise, if you see Paytm, Flipkart, Amazon, they will say year after year they only incurred losses. They have not made profits, but still they grow like a huge companies. Their valuation rises astronomically. So in these cases, banks are not going to give loans. So there are separate type of companies who are venture capital funds. These venture capital funds, they will boldly invest in this startup. They know there is a 95% failure. Still, how they fund is they fund in equity. They will charge very high interest and they will take some royalty and they will take some share in profits. So what happens is um, initially they might be investing some 1 crore. This 1 crore each, if they invest in 100 companies, their total investment will be 100 crores. But what kind of returns they get is that only 5% of the companies succeed and one of the companies will be a super hit success. So what happens is they will earn 100 times or 1000 times from that one particular venture. So in 100 crores, in some of the companies they will get only 50%. Let's say in 95% of the companies they get only 50 crore back. But in some of the success companies like Ola, Flipkart and all, they'll be minting money. Like let's say 200 crores they will get. For the 50 investment of 5 crores, they will get 2 crores, 200 crores. So they'll be ultimately getting 250 crores. But how they identify these successful companies out of this 95% failure, it is their specialized area. And if the company is failing, they will not stand aside and watch the companies failing. They themselves will involve into the management, marketing, and research and development. Everything they will involve themselves. A bank, if they give the loan, they don't come and monitor the business. They don't give any ideas to improve the business. But venture capital funds are specialized financial companies. What they do is if some startup is not able to do proper marketing, they will come into the picture. They will do the marketing and assistance for marketing. If they are weak in managing finances, they will help in managing finances. So like that, they'll be very closely involved in the management and running of the business. So they are more bold in investing in these startups. So these are called venture capital funds. These are regulated by SEBI. Then Nidhi companies. There are some companies which will be called as Nidhi companies, since these are regulated by MCA. What is MCA? Ministry of Corporate Affairs. So these companies are monitored by MCA, so they will not come under RBI purview. Then for insurance companies, there is a separate regulator who is called IRDA, Insurance Regulatory and Development Authority. So insurance companies will not also come under RBI supervision. Then chit funds. You would have heard about Shriram Chit Funds, which is very popular company. Like that, there are so many chit funds. All these chit funds are regulated by the respective state government Chit Fund Act. So this also excluded from RBI supervision. So we are not going to study about any of these companies in this particular chapter. Then what are we going to study about now? We will see the list of companies those have to compulsorily registered with Reserve Bank of India. The first set of companies are called asset finance companies. These are like Ashok Leyland Finance. You would have heard about. Ashok Leyland is a company who are making trucks and buses. The cost of trucks and buses are very high. Some of the transport companies, travels companies, they might not have sufficient finance with them. So they will go to the bank. But banks will be hesitant to give loans. But Ashok Leyland Finance, they will boldly give loans. How they'll be more bold in giving the loans? Because if the borrower is not repaying, they will immediately take possession of the truck. They have their own customers, so they can sell the second hand truck to some other customer. So they can very quickly act on that. But if it is a bank, they'll be having all types of advances. So if a truck driver is not repaying loan, by the time they take possession of the truck and finding some buyer, it will take a lot of time. It's a waste of time and money. So they will be hesitant to finance the trucks. But Ashok Leyland Finance, they have to improve their own truck sales. So whoever is buying, they will offer finance assistance as well. And they have the comfort that if somebody is not paying, immediately they can repossess the truck and they can sell it to somebody else. So these kind of companies are called asset finance companies. And then investment companies. There are companies, their pure purpose is to invest in either shares, debentures, or government securities. These are called investment companies. And there are some companies who are called loan companies. You would have heard about Manappuram and Muthoot. These are loan companies. What they do, Manappuram or Muthoot, they give loans for jewels. So jewel loans they are giving, gold loans they are giving. These companies are examples for loan companies. There are some companies who specialize in infrastructure finance. What is an infrastructure finance? Like roads, bridges, airports. For the construction of these, huge amounts are required and they will take loan for longer period. For example, if you take Chennai Bangalore, this Chennai Bangalore highway is for 300 kilometers. If they want to convert it into a 6-lane highway, what they will do? They will ask for a tender. In this, there will be a system called BOT, build, operate, and transfer. What the central government will say is that we want to construct 300 kilometers of national highway, which is 6-lane, but government will not give any money. Then why some private player will construct a highway? They will say that the cost of this highway will be, let's say per kilometer it cost 10 crores. So 300 kilometers, 3000 crores will be the budget of this 6-lane road. What you do is you have to build it and you have to operate it. Operate means they will say for 15 years period you can operate this highway. So you have to maintain and you can collect toll charges. So they build the road, they put up toll plaza and they collect toll. So every day they'll be collecting some, let's say 2 crores. Then per year how much they are getting? Per year they are getting 730 crores. So for 15 years government will not ask any money. So they will get 15 into 730. So this many crores they'll be getting. Initially they invest 3000 crores. They recover the investment in 5 or 6 years. After that they get a lot of money. So they take the risk and they do this business. So any construction company like L&T, if they want to take this particular contract for 3000 crores, so upfront they need 3000 crores. So some banks will be willing to give loans, some banks will not be willing to give the loans. Then they take loans from the infrastructure finance companies. Then core investment companies. Core investment companies are called, they are the holding companies. What they do is they hold the shares of other companies. So these are called core investment companies. Then infrastructure debt funds. So these are also a type of debt funds who are financing infrastructure activities. Then NBFC, microfinance institution. What is a microfinance institution? In a typical bank, the loan amounts will be like 50,000, 1 lakh, 10 lakhs, 20 lakhs, like that. But some people, they need loans in smaller amounts. Let's say 5,000 or 10,000 like that. So banks will not give such smaller amounts of loans. So these MFIs give these loans. A typical example will be self-help groups. There will be a lot of self-help groups where people come together. Especially women self-help groups are very popular in Tamil Nadu. What they do is some 20 members come together and they do some economic activity. For that, they will be getting the funds from banks. Let's say 10,000 per person. So instead of going to the bank, they will be taking the finance from the NBFC, who are specializing in this microfinance. Small loan amounts are called microfinance. And then NBFC factors. In capital management, in financial management, under working capital management, you will learn about what is factors. What is factors? Receivables management factors. We have lot of sundry debtors. Then we can assign a separate company for managing our receivables. They will do the billing and collection part. And mortgage guarantee companies. What is a mortgage? Any immovable property, land and building. If they are financing against land and building, then it is called mortgage. So if anybody is financing based on the land and buildings, these are called mortgage companies. An NBFC, non-operative financial holding companies. if any banks want to take license, like recently several banks have been opened. So if any new bank wants to get a license, then Reserve Bank says that these shares of these companies should be held by a separate NBFC who are called non-operative financial holding companies. What the purpose of these companies? They will hold the shares. They will hold the shares in banking company or their insurance arm. Most of the financial companies, they have a group of companies. For example, if you take ICICI Bank, they have a banking company which is ICICI Bank. They have insurance company. For life insurance, they have ICICI Prudential Insurance. For general insurance, ICICI Lombard General Insurance. Then they will have mutual funds. ICICI Essential Mutual Funds. So likewise, in a finance company group, there is a banking company, insurance company, mutual fund company, etc. So in this, there will be a promoter shareholding. All these shares should be held in the non-operative financial holding companies. So these are all will come under the purview of Reserve Bank of India. So do you want me to elaborate on any point or any particular company? Anyways, no examination question will come regarding this. What is this type of companies, what they do and all. This is only for our knowledge. Because it's not only for education and scoring, we should have some certain knowledge also. Once you come out as a chartered accountant, you are expected to know a lot about finance and finance companies as well. So to enhance our knowledge, we are reading all this. This is not from the exam perspective. There won't be any questions coming up in the exam. So now we'll move on to certain concepts which are very relevant for our examination point of view. One of the first and fourth concept is called net owned funds. If you want to start a NBFC or if you want to continue the NBFC, you should always have a minimum owned funds of 200 lakhs or 2 crores. So what is a owned fund? Owned fund is defined as the aggregate of 1. Paid up equity capital, 2. Compulsorily convertible preference shares, 3. Free reserves, 4. Share premium, 5. Capital reserves. These capital reserves should be from the sale proceeds of assets and not from revaluation of assets. So from this sum total, you have to deduct accumulated losses. If there are related losses, and if there are any deferred revenue expenditure or any other intangible assets, you have to reduce. These are, then this amount is called as owned funds. Then how to find out net owned funds? So from these owned funds, you have to deduct investments in shares of subsidiary companies in same group or other NBFC. So if we have any other subsidiary companies in the same group or other NBFC, we have to deduct those funds. What is the amount we have to deduct? The book value of debentures, bonds, loans, advances including hire purchase or lease finance, deposits with subsidiary in the same group. To the extent the sum exceeds 10% of owned fund. So if we have any debenture, bond, loan, advance, deposit with any our subsidiary in the same group, then we have to add them all. And we have to see whether it exceeds 10% of owned fund or not. If it exceeds 10% of owned fund, then we have to deduct that from the owned funds. Then we will get the net owned funds. So this is one of the important concepts we should remember. Then another, sorry, oh, screen sharing gone. So I was talking about, what is that? Screen sharing is not happening. Just wait a minute. Okay. Are you able to see now?
Yes, sir.
Are you able to see the Excel sheet now? I hope so you are able to see the Excel sheet. So,
Yes,
okay.
sir.
Minimum net owned funds is 200 lakhs. How we find this? These 5 items we have to add. From that, we have to deduct these 3 items. Then the result is called owned funds. And then move on to net owned funds. From the owned funds, you have to deduct these sum total of these amounts: debentures, outstanding loans, advances including hire purchase or lease finance, deposits with subsidiaries in the same group. Then you have to see whether this total is in excess of 10% of owned fund or not. If it is less than 10%, we have to just ignore this part. If it is more than 10% of the owned fund, so the excess over 10%, we have to deduct from owned funds. Then that number is called the net owned funds. So probably at this point in time, we'll work out some problems on net owned funds. We have had some examination questions, but not frequent, very rare, but still possible. We might get one question from this. So let's move on to page number. Where we have questions on net owned funds. Okay. We'll move on to this particular page. Illustration 1. Calculate the owned fund of a NBFC based on the following facts. Paid up share capital 150 lakhs. Free reserve 250 lakhs. Compulsorily convertible preference shares 50 lakhs. Revaluation reserve 95 lakhs. From this, we have to calculate the owned fund. So now we will see the definition what we have for owned funds. First, what we'll have the sum total of paid up capital. In this particular case, paid up share capital is 150 lakhs. So I will write 150 lakhs. And second item given is free reserves of 250 lakhs. So here it is. Free reserve is part of our owned funds. It is 250 lakhs. Somebody joined us. Then we have compulsory convertible preference shares 50 lakhs. So compulsory convertible preference shares 50 lakhs. And what is the other item we have? Revaluation reserve of 95 lakhs. So capital reserves are eligible, but not from revaluation. So we will not add that particular item. Do we have any item for accumulated loss, deferred revenue expenditure, or other intangible assets? No numbers are given. So what we will do is simply we will total these. So it is a sum total of these 3 numbers. So what is our owned funds? Our owned funds are 450 lakhs. So this is the answer. So what we need to do, we have to remember this definition and apply this definition on the sum. Then we will find out the answer. So 4 items were given. 3 items are eligible to be part of owned fund. 1 item is not eligible, so we are not considering. So the sum total of 3 items which are eligible is 450 lakhs. So that is called as the owned fund of this particular NBFC. So then we'll move on to there is one more illustration. Templeton Finance Limited is a non-banking finance company. It provides the following information. So in examination, how to find the question is from NBFC, they will clearly give. So here they have given as Templeton Finance Limited is a non-banking finance company. So we know that the question is from NBFC chapter. Then they have leased out assets 800 crores. Investment in share subsidiaries and group companies 100 lakhs. In debentures of subsidiaries and group companies 100 lakhs. Cash and bank balance 200. Sorry, all these are crores. 200 crores. Deferred expenditure 200 crores. Paid up capital 100. Free reserves 500. Loans 400. Deposits 400. You are required to compute net owned fund of Templeton Finance Limited as per non-banking financial company, systemically important non-deposit taking company and deposit taking company directions 2016. What are these directions? We'll learn little later. Yeah, yes. Solunga. Somebody was saying something. Excuse me. What's that? Shall we proceed? No issues. Okay, I'm just proceeding. So now we will apply this conceptual knowledge. So just now we have learned what is owned fund, what is net owned fund. So now they are asking us to work out the number. So this is the formula we will apply and find out the net. So I'm moving on to this. I have just given the Templeton Finance Limited balance sheet extract. So what I am doing is, if it is in this particular way, I don't know which is assets and which are liabilities. So I'm just tabulating in the form of a balance sheet. This is only for explaining you. You need not do this in the examination. Just to make the points clear to you, I am doing this. So paid up capital is 100, free reserves 500, loans 400, deposits 400. We have liabilities of 1400. You may ask, sir, deposits, how come it is liabilities? You should remember that we are reading about non-banking financial companies. For banks and NBFCs, deposits are not assets, they are liabilities. These are the amounts we have collected. So deposits will be part of liabilities only. And what are the assets? Leased out assets 800, and these are the investment in shares of subsidiaries and group companies 100, debentures of subsidiaries and group companies 100, cash and bank balance 200, deferred expenditure 200. So just for your better understanding, whatever question is given, I am showing as a balance sheet so that our understanding will be better, which is asset, which is liability. So now I will move on to work out the owned funds. So what I have to take it first, we have to go to the liabilities side. So which will be part of the owned funds. I have to see whether I have any paid up equity capital. I have paid up equity capital. How much I have? I have 100 crores. Then what are the other components? I have to look for compulsory convertible preference share. I don't have. Free reserves I have. So in this question I have free reserves 500. So I am taking this 500. I add these two. And then I want to see any share premium is there? No. Any capital reserves are there? No. So out of these 5, only 2 items are there. I have taken. Other 2 items are not eligible to be part of the owned fund. So liability side is completed. Then what I have to do? I have to look these things on the asset side. Do I have any accumulated loss? No, there is no accumulated loss. Then do I have any deferred revenue expenditure? Yes, I have deferred revenue expenditure of 200 crores. So I have to deduct these 200 crores. Do I have any other intangible assets? No, I don't have any other intangible assets. So what is my owned fund now? As per the definition, I added up 5 items, but only 2 is available in this question. I have deducted the 3 items, but only 1 is available in this question. So my own fund will be 400 crores. So now what I should do? I should move on to the net owned funds. So I have to first find out the owned fund. I have done it. Now I have to deduct these things. So I have to see the debentures, bonds, outstanding loans, advances, deposits with subsidiary companies in the same group. So all this will be part of the asset side. So leased out assets, no. Cash and bank balance, no. Deferred expenditure, no. Then these are the 2 investments which are made in the shares of subsidiaries and then debentures of subsidiary companies. What is the total amount? You have to add them up. First, I have to write the owned funds. How much is my owned funds? My owned funds are 400 crores. From that, I have to deduct shares of subsidiaries and group companies 100. Debentures of subsidiaries and group companies 100. Then what is the total amount? 200. 200 is the total investments I have made in shares and debentures of subsidiary and group companies. Now I want to see that whether it is more than 10% of the owned funds or less than 10% of the owned funds. My owned funds is 400. What is 10% of that? 10% of that is 40 crores. So what is the excess over 10% of the owned funds? 160. So this 160 is the excess over 10% of the owned funds. That's the concept we have studied. We have to sum up all these. To the extent the sum exceeds 10% of the owned fund, you have to minus. So I found that excess over 10% of the owned funds. So I am doing a minus from this. So 400 minus 160, I get 240. So what is my net owned funds? My net owned funds is 240. So owned fund 400, net owned fund 240. So this is how we compute the net owned funds. We'll have some examination questions. So be with owned funds and net owned funds. What we need to do is we should remove these definitions. That's it. And from whatever the question given, substitute the values in the formula, you will get the Answer. Then we'll have reserve fund. What is a reserve fund? In banks, we had something called statutory reserve. As part of the reserves and surplus, statutory reserve is the first kind of reserve we had. Similarly, NBFCs also have to create a reserve fund and transfer 20% of its net profits to the reserve fund. But we will not get any questions on preparation of financial statement NBFCs. Neither Let me share the screen now. So we were discussing prudential accounting norms and applicability. In banking companies, we have studied something about IRAC norms, income recognition and asset classification norms. These prudential accounting norms and their applicability is similar to these IRAC norms. The first norms of prudential accounting is that income recognition, asset classification, and provisioning. IRAC norms. So these are applicable to NBFC deposit taking, NBFC non-deposit taking, and NBFC non-deposit taking, which are systemically important. So it is applicable for all three categories. Then we'll move on to capital to risk weighted assets ratio. In capital adequacy ratio, we have studied in banking companies. It is similar to that. We have tier 1 capital, tier 2 capital, and how to find out the capital adequacy. Same things are applicable, assets, and there will be asset weights. But here, the assets weight will be different components of tier 1 capital, components of tier 2 capital are different from the banks, but overall structure of tier 1 capital, there are certain components, tier 2 capital, certain components, and certain risk weights to the assets. All these structure is the same, and we have not got any questions from this capital adequacy ratio so far in the examinations, so we need not focus much on this CRAR, capital risk weighted assets ratio. Basically, these are applicable to NBFC deposit taking and NBFC non-deposit taking, but systemically important. It is not applicable for NBFCs which do not accept public deposits. So it's only applicable for the first and third categories. Then we have credit concentration norms. These credit concentration norms are also applicable to NBFC D and NDSI. It is not applicable for the middle one, NBFC ND. So these are the basically prudential accounting norms and their applicability. In that, we will not concentrate much on the CRARA ratio and credit concentration norms. Our primary focus is income recognition, asset classification, and provisioning. Most of the time, examination questions we get only from this area. These two areas we have never had any examination problem. Then we'll move further on income recognition. We have already studied in banks. We have types of assets. One is called performing assets and another is called non-performing assets. Similar to the bank, performing assets, we recognize the income based on accrual basis. Non-performing assets, we recognize the income based on cash basis or receipt basis. So nothing is different from a bank. The same aspects are covered here. Then investment categories and valuation. Basically, the investments we have seen that there should be held till maturity HM and available for sale AFS and held for trading HFT. But here there are two categories only, which is as per the Companies Act. One of that is called current investments. Another is called long-term investments. How to categorize them? The accounting standards issued by ICAI, which is applicable for all the companies. So there are no special treatment in the case of NBFCs. So in the case of current investments, cost or value, whichever is lower, that will be that cost. For long-term investments, the cost will be according to the accounting standards issued by ICAI. In this module, going to study anything different about investment categories and valuation. It's universal. Whatever accounting standards, we will apply to these companies as well. And then we'll move on to asset classification and provision. So here asset classification is same like banks. One of the assets are called standard assets, where the overdue is less than 90 days. Then we standard assets. but the percentage of provision we need to make is slightly different. In the case of NBFC D and NBFC NDSI, it is 0.40%. In the case of non-deposit taking NBFCs, that is NBFC ND, it is 0.25%. So there is a small variation with respect to provisioning of standard assets. Then we have non-performing assets. For non-performing assets, NBFC D, NBFC ND, NBFC NDSI, all three types of companies, the provision percentage is same. So for substandard assets, if they are secured, we have 10%, or unsecured, we have 10%. So substandard means we need not worry whether they are secured or unsecured. For both the categories, the percentage of provision required is 10%. Then doubtful up to 1 year, secured means 20%, unsecured means 100%. Doubtful 1 to 3 years, secured means 30, unsecured means 100. Doubtful more than 3 years, secured means 50, unsecured means 100. Loss assets, doesn't matter whether they are secured or unsecured, entire 100% will be a provision. So this table we have to memorize. These are slightly different from what we have learned in banking companies. These percentages are different. These percentages are same, but these percentages are different. So this table we have to memorize. And when standard becomes substandard, after 3 months of overdue. Then when substandard becomes doubtful, after a period of 12 months. So this is how it's happening with respect to NBFC D and NBFC NDSI. This is for NBFC who are accepting deposits, or otherwise we call them shortly NBFC D, and NBFC non-deposit taking, but they have asset of more than 500 crores. So they are classified as systemically important. Then we have a separate rules for NBFC, which are NBFC ND. If they are not taking public deposits, then the rules for standard to substandard is different. So they have 6 months time. So for an asset to become NPA, they have 6 months time. And in the case of substandard to doubtful, they have a time period of 18 months. So these are the asset classification norms and provisioning norms. Let's move on to the study material. Investments, asset classification. we have studied these provisioning requirements. Now we'll study the NPA provision for hire purchase and leased assets. So there is an additional NPA provision we have to make for hire purchase and leased assets. I have summarized the provisions in this table. We have to consider the overdue period. If the overdue period is up to 12 months, then we have to provide nil as a percentage of net book value. So in the case of hire purchase and leased assets, there's a concept called net book value. So in the problems involving NPA provision, in the question, they will give this particular amount, which is net book value. Only this we have to consider for multiplying the NPA provision percentage. Yes. And overdue period up to 12 months, nil. And 12 to 24 months, 10%. 24 to 36 months, 40%. 36 to 48 months, 70%. If it is more than 48 months, then we'll make a provision of 100%. Then preparation of financial statements. It is as per the Companies Act 2013. We are not going to study anything separate in this particular chapter. Then capital adequacy requirements of NBFC D and NBFC NDSI. They have to maintain a CRAR of 15%. Capital risk asset weighted ratio 15%. Then tier 1 should be 10%. Tier 2 should be 5%. So one easy thing is that tier 1 capital is as simple as that net owned funds. We have already learned how to calculate net owned funds. That will be called as the tier 1 capital in the case of NBFCs. Tier 2 capital comprises of preference shares which are not compulsorily convertible into equity, revaluation reserve after discount of 55%, general provisions and loss reserves up 1.25% of risk-weighted assets, hybrid debt capital instruments, subordinate debt and perpetual debt instruments. Risk weights of the assets are listed in the tables. It's given in the study material. It's not a small table, it's a very lengthy one. But one saving is that we won't have any numerical problems. So we never had any numerical problems from NBFC calculation of capital adequacy requirement. But theoretical question may come, so at least these concepts you should memorize. CRAR is 15%, tier 1 10%, tier 2 5%. What is the definition of owned fund and what is the definition of net owned funds, and what are the components of tier 2 capital? All these you have to memorize so that we can answer any theoretical questions if it comes. We need not bother about risk weight of assets because practical questions will not come from this chapter. Then in the case of NBFC ND, the capital adequacy is not determined by this CRAR ratio. Simply they say the leverage is 7. What is leverage is 7? Outside liabilities by net owned funds. It should be the maximum of 7 times. Our outside liabilities can be a maximum of 7 times of net owned funds. So if our net owned funds is 1 crore, we can have an outside liabilities of 7 crores, 7 times. So that is called a leverage here. The maximum leverage permitted is 7 times. So these are the various constitutional things we have to understand from NBFC perspective. I think now we can move on to solving problems, numerical problems. Mostly the questions are from provisioning perspective. How to make provisions. Standard and substandard assets. And sometimes classification of assets as well. This illustration 3 is regarding classification of assets. We'll see it little later. Then we'll move on to question number 4. These type of questions we have it very often. So let's move on to the illustration number 4. While closing its books of accounts on 31st March, a non-banking finance company has its advances classified as follows. Standard assets 16,800 lakhs, substandard assets 1,340, secured portion of doubtful debts up to 1 year 320, 1 year to 3 years 90, more than 3 years 30. Unsecured portions of doubtful debts 97. Loss assets 48. Calculate the amount of provision which must be made against the advances as per non-banking financial company, non-systemically important, non-deposit taking company, directions 2016. So now we have to find out the provisions. If you look at the table, the provisions for NBFC D, NBFC ND, NBFC NDSI, everything is same. Substandard, doubtful 1 to 3 years, 3 years, loss asset. It is one and the same. But only in the case of standard assets, the provision differs. If it is non-deposit taking, 0.25. It is deposit taking, it is 0.40. So based on this table, we have to work out the provisions. This is question number, illustration number 4. So the question I have 31/3/2020 and rupees in lakhs. I have given us a standard asset, substandard asset, secured portion of doubtful assets, unsecured portion of doubtful assets, and loss assets. And we have to apply the rates as per the NBFC deposit taking and NBFC non-deposit taking NBFCs. So first we'll start with NBFC which takes deposits. So first we have standard assets. What is the provision? If you look at the provision for NBFC deposit taking, then it is 0.40%. Amount will be 67.20 lakhs. So rupees in lakhs. Then for substandard assets, we have to refer the table, whether it is secured or unsecured, it is 10%. So I'll write substandard assets, percentage of provision is 10%. Then I will get the answer 134 lakhs. Then secured portions of doubtful debts up to 1 year. Up to 1 year means 20. 1 to 3 years 30. More than 3 years 50%. So you have to apply this 20, 30 and 50%. An unsecured portion of doubtful debts. It is 100%. Loss assets 100%. So for unsecured portion of doubtful assets and loss assets will have a provision of 100%. So what will be the total? You have to prepare a table like this. You have to have a classification of assets. Classification of assets. And then the amount as given in the question. Then the percentage of provisions based on these tables. This you have to memorize and apply the respective percentage. Then you multiply the respective amounts with percentage. Then if you do the sum total, we will get the amount of total provisions. So this is as per the NBFC deposit taking. Companies provision percentages. Then provisions as per NBFC ND. So classification will not change. So classification of assets. Then we have percentage of provision. Only in the case of standard assets, the percent will change. It is 0.25 percentage. For substandard, it is 10 percentage. For doubtful asset, it is 20, 30, and 50 percentages. Unsecured portion of doubtful debts, 100%. And loss assets, 100%. So the total will be 4,27,000. So where is the difference? The difference is here. For the standard assets, it is different for different type of NBFCs. Apart from that, the answer will be the same. As we have already learned about this, how to do this, what is the format of the table we should use. First, we should have the classification, then amount as per the question, then percentage of the provisions, and then amount of provisions. So I'm going in this. So I'm just explaining the mechanics of how to do this. Only these percentages are the difference between banks and NBFCs. Otherwise, this process is the same. So then now we'll move on to further problems. So this also we have completed using the two different regulations. Now we'll move on to illustration number 6. Babu Bhai Financials Limited is an NBFC providing hire purchase solutions for acquiring consumer durables. The following information is extracted from its books for the year ended 31st March 2011. So this is a hire purchase solutions. So what we have to do, the provisions in respect of hire purchase assets, it is slightly different. So we have to use this particular table. We have to see what is the overdue period and what is the percentage of net book value. So they have different type of assets financed, assets funded, then interest overdue but recognized in profit and loss, period of overdue and interest amount. Then we have net book value of assets outstanding. So what is relevant? The period overdue is relevant for us and net book value is relevant for us. This amount we need not bother. For making provisions, what the amount we need is the net book value of assets. So now how to answer this? We should have the assets funded, then period overdue. Then we should have the percentage of provision and net book value. If we multiply the percentage of the provision with the net book value, we will get the answer. So let me prepare the table for this. One is yes. So this is the question. How many type of assets? 1, 2, 3, 4, 5. Where I have it? Yes, here I have it. Illustration number 6. Provisions required for hire purchase. So this is the illustration number 6. So I have prepared a table already where I have assets funded. What are the assets funded? LCD TV, washing machine, refrigerator, air conditioner, mobile phone. So LCD TV, washing machine, fridge, AC and mobile. And period overdue. Period overdue first is up to 12 months. So I write it is up to 12 months. Then washing machine, $24 months. So it is up to 24 months. Then fridge, it is 30 months. Air conditioner 45, mobile phone 60. Making 30, 45 and 60. Then what is the next values we need? We need the net book value. Net book value is, in case of LCD televisions, it is 20,000 crores. In case of washing machines, it is 2,000 crores. In case of fridge, it is 1,250 crores. And air conditioner, 600 crores. And mobiles, 100 crores. Next, what we need to do, we need to apply the percentage of provision. So let's move on to the concept. Up to 12 months, the provision to be made is 0%. So no provision at all. It is 24 months, where it is 12 to 24 months. The percentage to be applied is 10. So we'll apply the 10% here. And third is reach 30 months. So in this concept, we have to see where this 30 months falls. It falls under this category, 24 to 36 months. Percentage is 40. So we have to multiply with 40%. Then air conditioner. In the case of air conditioner, how many months overdue? 45. Which bracket it falls? Here it falls 36 to 48 months. Percentage is 70. So we will multiply a percentage of 70 here. Then we have mobiles overdue for 60 months. This falls under more than 48 months. 60 is 48, so we'll have 100% provision. So the provision is 100%. 20,000 into 0, 0. 2,000 into 10, 200. 150 into 40%, 500. 600 into 70%, 420. 100 into 100%, 100. So total provisions required is 1,220 crores. So it's also very simple. Once you know that particular table, this particular table you have to memorize. Then it is very simple. The multiplication and sum total of products. That's it. Let's move on to accounting year, disclosure in balance sheet, preparation of financial statements. No practical questions will be coming from here. So requirement of capital adequacy, that I have already summarized. There are so many pages which is devoted to computation of CIR. Since there is no practical questions, so we can easily skip that. So this is a theoretical, so that you can read yourself. We look for other practical questions. Okay. There is one more question. Question number 1. While closing its books of account at year end, a non-banking finance company has its advances classified as follows. Standard assets 84,000, substandard 6,700, secured portion of doubtful assets up to 1 year 1,600, 1 to 3 years 450, more than 3 years 150. Unsecured portion of doubtful assets 485. Loss assets 240. Now what is required? Calculate the amount of provision which must be made against the advances as per the NBFC non-systemically important non-deposit taking company directions. Then question number 2 is using the same information, calculate the amount of provisions which must be made against the advances as per non-banking financial company, systemically important non-deposit taking company and deposit taking company directions 2016. So there are two regulations, as I told you, non-systemically important non-deposit taking company and systemically important non-deposit taking company and deposit taking company. So both the regulations we have to find out the provisions. So what we have to do, we have to create a table. The first column will be classification of assets. You have to write all these. Then amount of assets. Then you have to write all these. Then another column will be for the percentage of provisions. Then the multiplication, this amount into percentage of provisions. Then we have to do the sum total. Then we'll find out the amount of provisions to be made. So let's move on to the question 2. So I have this question number 1. I already prepared